Thank you, Francois. Today, I'm going to be discussing two topics for you. The first one is to look at those red flags that you must consider as a South African tax and exchange control resident relating to offshore structures and products you may wish to invest in. And the second part is, again, red flags that you must consider from a South African tax and exchange control resident relating to those same offshore structures and products where there's a change of tax residency or where you're thinking of changing your tax residency. So when we're looking at the first topic, global South African tax and exchange control resident, the first question that often comes along is what and who are those? Now, a South African tax and exchange control resident is basically somebody that's a tax resident in South Africa. The law from a Reserve Bank side has changed, and the two has now met with a single definition of being an SA tax resident. Hence, if you're a South African tax resident, you are subject to South African tax laws and exchange control regulations. Now, when you're looking at offshore structures, the first thing that you must consider is that because you are subject to these laws, some of the international structures or where you've got structures and you want to change structures may need careful consideration, and one can't just do stuff without considering the exchange control and tax implication affecting you. So from an exchange control perspective, there are cases where people actually get penalties where they've got existing offshore structures and there's asset swaps, for example, because those need prior approval from the South African Reserve Bank. South African residents often also look at offshore structures specifically from a family context for safety against political and economic conditions in South Africa. To ensure that fund and monies are kept safe, we will typically look at offshore structures, which will incorporate your multifamily legacy structures, which is an offshore trust and company, either both or just the one. So those same structures also lend towards business structures where you can mix an offshore company with a legacy structure where you do offshore trade and the profits then goes ultimately to an offshore trust where those can be invested by your financial advisor. So when we look at these offshore structures, there is so much to consider, but probably the most important is what structure will you be using and what is the funding mechanism that you're going to be using to fund that structure. So the first one that's gained popularity recently is your offshore pension fund trust. Now these are funded by a pension premium. Now as it is a premium, the assets that you contribute to this fund moves off your balance sheet, which means that on death there's no estate duty and there's potentially no capital gains tax, as the asset no longer sits on your balance sheet. So from a pension premium contribution is actually a great product. However, one must be careful because SARS has recently issued their interpretation note on this product where they add their interpretation of the Income Tax Act, and that depends then on the nature of the pension fund trust you use and whether you fulfill of the tax implications attached by SARS. So if you go that route, careful consideration is important. The next offshore product, which is very popular, especially in the financial investment space, is your offshore endowments. Now, offshore endowments, there's two types. Most South African providers will only use and promote, and they're only legally entitled to, as far as I'm aware, regulated products, which means it's endowment policies that's issued in terms of South African long-term life insurance legislation. That means that whilst the fund sits in that policy, it's taxed according to a fund principle, and SARS will receive taxes from the policy or the insurance house on a regular basis. And for the investor, it's great because normally those rates are lower than those that you will have in your own name directly. Now, unregulated products are also provided by life insurance companies, but these are foreign life insurance companies, and their policies are regulated in terms of their legislation. In these cases, those funds that sits in the policy, again, the premium will take it off your balance sheet. It will go into the premium, but it's not taxed whilst it's in the policy. However, on redemption of that policy, there will be a capital gains tax event, which is not the case in a regulated policy for the investor at that point of time. So one must consider both options and get professional advice when you consider those. If you look offshore and you will start looking at companies or foundations, now the funding mechanism there is typically equity funding, which means you subscribe for shares. Now, one must be very careful when we go offshore equity funding structures, as there is a lot of tax avoidance provisions in the Income Tax Act that can bite you. Probably the most famous is if it's an offshore, if it's a foreign company and you own more than 50% equity shares in that company, then you're subject to what they call controlled foreign company legislation. The controlled foreign company legislation basically has the impact of imputing tax from the company according to your shareholding back into your income tax computation in South Africa. In other words, you pay tax on a foreign income. Now, there is an exemption for that, and that's what we call a foreign establishment. Unfortunately, one other asset provider recently got their fingers burned as the foreign business establishment exemption dispute against SARS failed, and they had to pay a substantial amount of monies towards SARS. Just another variation, a foundation. A foundation is not so well familiar for South Africans, mainly because it's seen as a company. However, it's a hybrid between a foundation and a trust. So a foundation is a very unique structure. It's very commonly used in what we call civil law countries, Europe mainly, as it's more aligned for the legislation. From a South African perspective, we will see a foundation as a company, and it has similar tax consequences to it. Then currently there's also obviously unit trusts, but closed unit trusts specifically. So there is a popularity that's picking up where people create an offshore trust, which is a trust with unit trust. So it's trust deed provided the client or the establisher subscribe for a unit trust. It's not an open trust to the public, so it's not subject to all the legislation requirements needed. So because it's a unit, it can't be a share, it's also not debt, hence it falls basically through the gaps from the current tax avoidance legislation. And one must just consider again, it is complicated, and one must be very careful and get a right legal tax opinion to support your structure, depending on which way you're going to go. So if we now look at what are the tax risks with these funding mechanisms from an SA tax perspective? There are various tax risks. So the first one is obviously our pension fund trust, back to number one. So here SARS will say Section 7.1 of the income tax is applicable. Now Section 7.1, all it does is to say is where you have an asset that's held by somebody else, and that asset then accrue income or capital gains, because there's always a CGT match to it, that income should actually be taxed in your name. So Section 7.1 is saying when you made this pension contribution to the pension fund trust, the pension fund trustees invest the funds, but it's actually for your benefit, hence there's an income tax liability that needs to be attributed back to you. Now again, this is SARS viewpoint, and one can argue against it. What is quite a relief is that when the contribution is made, there was also a fear that because it moves off your balance sheet, this asset that goes into the fund, there's a donations tax implication because the asset is no longer on your balance sheet. However, there is an argument against that, and SARS has confirmed it, that because you get a right to a future income stream, that it can't be a donation. There's a quid pro quo for that. Hence, there is still a right sitting onto your balance sheet. And for that reason, it's SARS' view that from an estate duty point of view, that right will form part of your estate for estate duty purposes. Although, again, there's contra-arguments against that. It really depends on the nature of that specific pension fund trust. So when we look at premiums to life insurance products, regulated and unregulated, so the two of them works opposites. So if we talk regulated endowment policy, South African life insurance policies, they fall outside the capital gains tax net, although they pay capital gains tax within the policy itself. But from the investor perspective, you don't pay capital gains tax when that policy redeems. And on death, that asset is a deemed asset for your estate, so there will unfortunately be estate duty on death. On an unregulated policy, the opposite applies. So in an unregulated policy, on redemption, on death, there's a capital gains tax event, but for estate duty, you will get out of the estate duty net. So they work slightly different. When we deal with loans or preference shares or funding to a trust or company, the moment we talk debt and a preference share, obviously depending on its rights and obligations attached to it, would most of the time take the nature of a debt, although depending again on the rights, it could be seen as equity. if it's seen as debt, one will look towards a lot of well-known tax avoidance rules, specifically the transfer pricing rules in Section 31. In short, they want you to raise a market-related interest rate. If you don't raise a market-related interest rate in terms of Section 31, then there's other attribution rules kicking in, or tax avoidance rules. These will then have the following effect. So you'll have Section 31, you have attribution rules, and there's a third one coming into play, Section 7C. Long and short, what it will do is we'll say, if there's not a market-related interest rate, first of all, if there's an interest rate, we'll tax you on that. The difference between that interest rate and what is not market-related, we'll go fetch the income in the trust and go take it and attribute that back to you, and then we'll tax you on that. And then that amount of adjustment will then also be deemed to be a donations tax for Section 7C purposes. So long and short, if you do funding through debt offshore, you need to make sure whatever you charge as a market-related interest rate. There's specific guidance on what that is, but a long and short is all about benchmarks. So one will look at what benchmark would we look at. Specifically for an interest rate, the most easiest benchmark is if I go to the bank tomorrow, ask them to borrow money from them, depending on my risk profile, security of the loan, term of the loan, repayment dates, what will the interest rate be that the bank will apply. Now, if that interest rate is 10, and I've negotiated with my own connected person trust, a lower interest rate, I'm probably going to be in hot water and have some tax consequences coming in. Right, the next one again is back to equity. So as I mentioned earlier, we need to watch out for Section 9D. Section 9D is a very difficult section to get out of, and SARS is really taking a keen interest in it. From a high network structuring perspective, one can, however, break the link of Section 9D. Most of the time, what we will do is set up an offshore structure owning a company. And at that point, even though the beneficiaries, which is normally discretionary beneficiaries of offshore trust, is South African tax residents, we break the Section 9D link, as a 9D can't pierce through an offshore trust. Hence, it's a little bit of a buffer, which works well. And then again, unit trust. Again, we talk of closed unit trust. I guess from a tax point of view, because a unit trust is not a share, it's not a debt, it's a unique asset on its own. And these unit trusts I'm talking is unregulated. In other words, it's a private unit trust. Possibly the only section I can think in my mind that could attack it is again that Section 7.1. Now 7.1 again is when you invest assets in a foreign entity or somebody else's name, but it's actually your asset, and that income needs to be attributed back to you. Now, a lot of these offshore structures, especially when we move into the trading scenario, so in other words, you have an offshore trust and we might have an investment, two companies below it. So one we'll typically use for passive investments and the other one is maybe for trading. So the guy maybe does trading into the rest of Africa and receives some profits or dividends or whatever the relationship is there into this trading entity. Now, historically, we had a lot of fun in choosing jurisdictions for such a trading entity. And that is what we typically did, is what they call treaty shopping. So we will look at different countries and say, let's put a company in Mauritius, for example, because Mauritius got a beautiful double taxation network with the whole of Africa. And if we use that as the intermediary, the dividends tax maybe from one country to the other will be reduced, and it will save ultimately tax. So with effect from 23rd of January this year, we've received a president from the OECD. And the OECD is basically the global organization that drives tax policy globally. Now, all countries, including South Africa, have subscribed to something called the BEPS. Now, BEPS means base erosion profit shifting, and there's a lot of action grounds that globally that all countries agree to implement to avoid tax avoidance. Now, the long and short of all of this is one of the action grounds resulted in an instrument. Now, that instrument is called the Multilateral Convention to Implement Tax Treaty-Related Relief, or short MLI. So this instrument, what it does is that this instrument, when it's applicable, overrides the DTA benefits. So for South Africa, basically it means that most of our double tax agreements with other South Africans is now subject to this instrument, and it's now referred to as a covered tax agreement. So where before I could just quickly look at jurisdiction A and B, to choose a trade relationship between parties, I need now to consider an extra step. Now that extra step can really bite you, because if you think you're going to have a benefit of withholding tax on a dividend, for example, the MLA can kick you out of the playground. What makes it very scary, though, is the one thing that South Africa agree as part of this instrument is to say, if one of your principal purpose of doing an international structure and using international agreements is tax avoidance, it's immediately applicable. So it doesn't even have to be the sole or main as other tax avoidance legislation. It's got to be just a principal test, and that's really dangerous because it will affect offshore structuring quite a bit. Now, the last one that one must just look at also from a reserve bank is our loop structures. These have become regulated and is allowable in South Africa. SARS has slightly kicked back since it's been introduced. However, recent loop structure has shown us once we make the Reserve Bank happy that the rights are commercially justified attached to a loop, we tend to get those now through. So if you want to go that route, just legal advice is very, very important. So now if you're already a South African tax resident and you want to leave South Africa to go live in Portugal, America, New Zealand, name it, the world's your oyster, then there is tax consequences that's going to affect you. Now, one must be very careful. If you've got a simple balance sheet and you're young and you only have cash, maybe it's not so bad. You can pretty much go anywhere in the world, provided you've got your residency permits or your passports ready, you'll be fine. But when you're in a situation where have already accumulated substantial assets in South Africa or offshore structures, you've got to be very careful when you enter another jurisdictions. So from a South African point of view, any asset that you hold will have a tax consequence. There are exemptions. So our Section 9(8) of the Income Tax Act will say there's a deemed capital gains tax event for you. And possibly there might be a complication with regarding to trust and companies. Now, if you have, for example, a trust and a company in South Africa, you leave South Africa, you pay your exit tax for CGT, but you remain to be a trustee or director of that company. By consequences, you could migrate those two entities as well, which can really bite you in both instances. So from a cash flow perspective, it's also important because when you do immigration from South Africa, you need to disclose all your assets and liabilities. So SARS, before you get your immigration PIN, it's nothing more than a cash flow exercise. They actually want you to show each asset that's on your balance sheet at that point of time. And often they'll ask you for proof of purchase consideration. So if you put stuff down like furniture, for example, they can reject your immigration PIN if you can't show receipts for all the furniture that you bought over a period of life. And it is very sad, but it's one of those truths. So when you do immigrations, for example, from a cash flow perspective, be careful what you put in, but be as honest as you can be, because non-disclosure is also not a good position to be. So with companies, shareholding in companies, there's a lot of complications, and specifically when that company holds a fixed property in South Africa. Now, prior to some changes, a company that held fixed property in South Africa were exempt from the deemed CGT event on immigration. However, SARS has a few years ago changed the legislation, and with that immigration to shareholding in a company that owns property now triggers a capital gain. But what the reality, however, is this is one of the exceptions where this same company will stay in a South African tax net, where generally all other type of assets that's triggered a CGT event goes outside the tax net. For example, if you own shares in the stock exchange, immigration will treat a CGT event on those shares in the JSE, and that's it. Once you're a non-resident, you won't pay tax on capital gains tax on those shares listed on a JSE. But in the case of a share in a property holding company, then you're going to stay in the system. So you basically will have a step-up base cost. But if you now subsequently sell the companies or the property out of the company to a potential purchasers, you will pay capital gains tax at the company rate in South Africa, and you won't get in the benefit of your step-up base cost at a share level. Hence, if you don't do your future selling planning properly, you could end up paying double tax unintended to. So careful planning is quite important in those cases. So What can you do then if you're about to immigrate? So first of all, the most important is to get your balance sheets right. So look at balance sheet, what assets are sitting on your balance sheet, and which of these will trigger a capital gains tax event. Even though some of them might not trigger a capital gains tax event, you might choose to trigger a capital gains tax event, because if you go into another jurisdiction where they don't recognize a step-up base cost at market value of date of entry, you might find that you're going to burn your fingers at some point of time. So what I'm saying is here, so even though you have a deemed CGT event on assets, whether they're exempt or not for immigration, often you're better off when you go into the new country to actually realize the actual capital gains tax, pay your CGT, but get a real step-up base cost. Because as you enter the new jurisdiction, they might not recognize this notional capital gains tax event that happened in South Africa. So if you have a real capital gain, it's a step-up cost in a new country of residence, because those countries will also have a capital gains tax event at some point for you in the future. So you got to just look at South Africa side, you also got to look at the country of where you entry into. So other stuff that you also need to consider is, what about trust assets? So what do we do with trust and trust assets? Now, most of the time, if you go to, again, a civil law country, you'll find that trust assets are taxed as pure revenue when it comes to you. And you will be in a very bad position, actually, from a South African perspective, because if you apply South African tax laws to a distribution to a non-resident, any income at the moment can still flow through, but there's legislation lying on the table where they want to trap that at a corporate of the tax rate in the trust. So that's already 45%, capital gains is 36% before the asset can leave the trust. And when it goes into the next jurisdiction and when you tax resident there, it will most likely be taxed as revenue. So you can imagine if they add another 45 or 30 or whatever rate there, you probably lose the whole distribution just in taxes. So for a lot of cases, one must maybe consider looking at terminating trusts if the subsequent consequences might bite you more than that is needed. Same with indirect ownership in companies. Again, from a South African perspective, you will have to get off boards, board of a trust, board of a company, and also once you're offshore into another country, their foreign legislation may also apply, which imputes, again, income into that jurisdiction, and you might have in South Africa. So again, you've got to look at those assets, decide, is it worthwhile keeping? And if you're going to keep it, what is the best structure from a new perspective, and what's the implication from a South African perspective? So when we exit South Africa, it's important that you understand those offshore investments, and specifically what is the income tax implications that can hold for you in South Africa, but also in a new country of jurisdiction. So typically from South Africa endowment structures, there could be a negative tax implication in a foreign jurisdiction. So a South African endowment is geared for South African legislation, gives you lower tax rates from a South African perspective. However, remember, with an endowment, SARS are receiving taxes on a regular basis from the insurance house. But when you're in a new country of jurisdiction as a tax resident there, first of all, you actually don't have to pay taxes to SARS anymore. So that just purely on that point, you probably don't want to be there in a South African endowment. But secondly, if you do keep it and that endowment pays out, in a foreign jurisdiction, they might see this endowment similar to the trust because they won't understand what it is. And if they apply their legislation, a lot of the foreign countries will regard it as similar to a trust. And the consequence is that you will then end up paying tax on the proceeds from that endowment structure, even though if you were in South Africa, that subsequent payments phase would have exempt you from a capital gains perspective. So you need to consider whether a South African endowment will help you in a foreign jurisdiction. You might have to change the investment strategy there. Same from South African trusts and companies. Important thing is here what we call control, effective management and control in distributions. There's two legs. So if you sit on the board of either of them, you should get off. For example, if you're in a trust and you as a trustee and you go to Australia, you immediately, just by that fact, pull in that trust as tax resident in Australia, which means a trust is potentially taxable in South Africa and Australia. So that's not a situation you want to be in. Similar with companies, you can pull out a South African company through you being maybe the sole director of a company as a resident into a new country, which means you exit as a company, you immigrate the company from South Africa, which has huge tax implications for you. For example, the company is deemed to sell every asset it owns at a market value, and it's got a deemed dividend event at that point of time. Hence, it can really bite you. So plan carefully. So very important, and I've mentioned it before, when we exit South Africa, what's happening from a CGT, the Section 9H perspective, is all notional. It's not real. Tax is a lot about notional stuff and not real. So when we enter into another jurisdiction, they might not respect our tax laws. In other words, they might not acknowledge that this notional event has created a new base cost for you in a new country of tax residency. So in a new country of tax residency, they would only recognize the actual cost. So when you bought the house for R1 million, not when it's now worth 3 million rand, and you potentially paid, it's a bad example because it's a house, you paid potentially, let's call it shares. So you bought the shares for R1 million, it's worth 3 million, and you pay now a capital gains tax on a 2 million. So the new country of jurisdiction may not realize or acknowledge the 3 million as a new cost, even though you pay tax in South Africa, is that they may hold you back to the historic cost. So one day when you sell that asset as a tax resident in a new country, they will keep you from the historic costs to the current market value that can be more than 3 million rand at that point. So you can end up picking up a huge subsequent tax liability in a new country of residence. So for a lot of strategies for entering into new jurisdiction might be to realize actual costs for going into that jurisdiction. Again, exchange control is important to note. When we exit tax, we exit exchange control. Once you exit the system from an exchange control perspective, you're basically free to reinvest back into South Africa. And there's something like historically we had called block accounts. Those all been removed about 2 years ago. So the position is quite friendly. So once you come back as a non-resident, you can bring money back and remove it out quite freely. But obviously you will note on SARS as you exit what assets were still remaining on your balance sheet in South Africa as part of the process. So lastly then, what is the tax residency for the board appointments? I've already discussed it, and one must be very, very careful. You may need to appoint other professional firms or somebody to take up a directorship. However, if it's a trading company, you might not be in luck. So if you're going to exit South Africa and you want to keep your business interest in South Africa, you need to build up your network of trusted colleagues, especially when it comes to trading businesses, because you might have to hand over control so you don't get any other negative tax consequences. So from all of this that I've discussed today, I hope you find it valuable. There is so much more that I can share with you, and if you have any questions, please let me know.